Started. So again, thanks everybody so much for being here today. And we're going to dive into, I'm going to share with you a lot of different ways that you can go about and, start trading this upcoming earnings season, which as everybody knows pretty much, it can be pretty crazy and volatile. Each season is sometimes can be a challenge, but there are also a lot of great trading opportunities, and it's actually a lot of fun as well. So again, thanks for being here. And just, I love these kind of Saturday events because markets are closed, we can kick back and we can just really focus in. Today, we're going to focus in on a number of different earning strategies, but, feel free to ask questions as we go. And we'll get started here in a minute. But just a little background on myself. I've been, actively trading on my trading journey, I guess, since the 80s, mid 80s. I started with was fortunate to get in on the oil side, trading crude oil and products and things like that. Started out with a company called Coastal Corporation, and they actually had a training program that would train you how to trade crude oil and products and things like that. So was fortunate to get into that group, and sent me down to one of their big refineries they had in Corpus Christi, Texas. Spent about three and a half, 4 months there. Which was great, just learning the kind of the process of oil coming in, putting out the different products from it, gasoline, fuel oil, things like that. Just kind of learned the really good basic foundations. And so that kind of started out my trading journey there. Went on into their shipping department, learned the operations side, and eventually got into the cargo trading on crude oil, and was very fortunate to be able to go out to Singapore for a couple of years with Coastal. Sent me out there and learned how to trade a lot of the fuel oil, MoGas, and Asian crudes. And then got a job at a company called Transworld Oil, which was at that time the largest oil trading company in the world. It was Transworld, Figaro, and Mark Rich. And so that was really, really exciting. So spent 17 years there with Transworld, about 16 years with them at Bermuda, which was their corporate headquarters, and ended up running the international trading desk out of Bermuda for 10. So fantastic experience, beautiful place. If you ever get a chance, make sure to check out Bermuda. And we pretty much traded everything, foreign exchange, all the different futures markets, and started trading options back in 1987 on crude oil. And so kind of never looked back since. So that kind of really piqued my interest as far as using options. And today we're going to get into how to use options for your earnings type trades. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So have you noticed how earnings can be horrendous and the stock goes up? Or you'll have the earnings that are just, they look off this chart fantastic and the stock tanks. So this is, what I call the earnings confusion. So when a company has an earnings conference scheduled, many times there's going to be speculation not only into the, accuracy or the projections of their earnings that they release and their revenues and things like that, their performance, but other factors as well. They could be all of a sudden kind of surprise the market saying we're going to do a big layoff, we're going to buy another company or whatever. So you really don't know. There's a lot of uncertainty going into an earnings conference call, and that's what can really drive volatility and make some crazy market movements. So it's this uncertainty that typically causes an increase in the volatility in the shares being traded. And that's the big diamond in the rough. It is this temporary parabolic rise in the volatility that spikes the prices of your options. So, what basically happens is traders are going to tend to stay on the sidelines going into the days leading up to an earnings conference call. And then all of a sudden, you're going to realize the potential risk that's out there, and you'll have call buyers. They're going to start swapping out their shares of their long stock for long call option positions, so they can participate in the rise should the shares move higher, but they want to reduce their potential downside exposure if the market should come off. So you get a lot of call buying interest, swapping out shares of stock for calls, and just speculation as well. Now, additionally, you're going to have the put buyers are going to be forced into the option market as well. So they're going to force the option prices higher also as they start trying to protect their positions from any major downside movements. So it's all this concentrated option buying. In many cases, it will dramatically expand the volatility levels of your stock being traded into their earnings release. So as an individual trader, we can then take advantage of all this uncertainty and volatility in order to capture profits from this crazy movements. So no matter what the market is doing, whatever the crazy earnings and reactions are, if you just know the right setups, we can participate in these kind of opportunities to present themselves every earnings season. Now, kind of a few steps that I'll go through is step one is you want to be able to identify and qualify a specific stock by looking at its past performance. You want to look at the probabilities of this particular stock heading into its earnings. So we want to look at the history to see, well, what is it, tendency for it to do past? And so a lot of times these kind of tendencies will repeat, and that's kind of what we're looking for. So we want to then find those stocks that have their earnings released during a weekly option expiration. So we want to take advantage of that weekly option because that's going to give us the highest implied volatility, going into the week of the earnings release, and we can have short duration on our trades. So a lot of good benefits, which we'll talk about. Now, step two is we want to then, look at the past performance. We want to really evaluate that. We want to see what the volatility has done previously to a stock as it moves closer into its earnings release and even after. So we want to see if we can spot some kind of opportunities that tend to kind of consistently come up with a specific stock. So that's a really important step. And then this will get us more prepared to look at the dramatic increases in stock volatility. Now, typically a stock, normally if you look at implied volatility ranges, stocks are typically 25 to 40% implied volatility. Excluding some of the the really high beta type stocks, but typically 25 to 40% implied volatility. But the week of the earnings release, this volatility can easily move to extremes of 2 to 3 times what's normal, and that's what we can get prepared to trade. Now, this is what makes a stock potentially great profit opportunity. So volatility a lot of times will normally double, and in some cases it will be even more extreme than that. And that's what we want to look for, and that's going to present us the different various opportunities for trading a specific stock as it goes into its earnings. Now, here's just an example of how extreme volatility can get. This was NVIDIA, and this, you can see where it was trading. This was back in its younger days. It was traded here at $270. So the earnings were going to be released on the 13th. So this was going to be a Thursday, and then one day later was expiration. So this is kind of typical of a lot of these types of stocks. So you can see this one day to expiration, the implied volatility here was jacked up to over 114% implied volatility. Now, normally, you can see here NVIDIA, these are the other series behind it. You can see normally it's 45, 40, etc. But in this case, it popped up to 114%. So you can see that huge spike in the implied volatility over 3 times kind of the normal implied volatility. And this number here is the expected move for that one day. So it's saying it theoretically it could go up $17 or it could go down $17. So that's just one standard deviation. So you can see the potential, the extremes of this. So, if you look at a normal distribution curve and you can see that NVIDIA, say, is trading at 271, the implied volatility for a normal move is that it could go up here plus $17 to the upside, or it could go down $17 to the downside just in this one day period. So that's a huge move, and that's one standard deviation. And a lot of times we're going to see potentially that these movements could be 2 standard deviations or even more up or down. So this is what we want to be prepared for and to understand how to take advantage of this and the different strategies to use for trading this kind of jacked up implied volatility. So here you can see the day after its earnings release, you can see where it's what we call a volatility crush. And the price has also spiked up 7.5%. Now it's at 291, but look at the implied volatility. it crushed, it completely collapsed down, and now it's back down to its normal range. So, you know, the day before it was going at 114%. Now it had crushed and was down back to kind of the norm. So that's a couple of things that we can look to take advantage of, that high spike in implied volatility. And so when you're, you know, selling options and option strategies that sell options, we're basically selling volatility and selling time. So that's one way that we can take advantage of that high implied volatility. So we'll look at that here in a minute. So, you know, a day after earnings release, volatility crush and the spike was 7.5% up is kind of what you're looking at in this chart. You can see, you know, visually that the implied volatility, this blue line, you know, had been trending up going into this earnings release, and then it totally collapsed. That volatility came out of it, you know, when the uncertainty of the stock was, you know, everything was, uncertainty was out of it after the earnings release. They released the earnings, any news, et cetera. So there's no more uncertainty, and it collapsed. But not only did volatility collapse, but you had a huge spike of 7.5%. So a couple different trade strategies to take advantage of both of those types of situations, which we'll talk about here in a minute. Now, for this reason, it's essential to, you know, have a watch list of stocks that you can monitor closely, due to the fact that they're not all going to present kind of an equal trading opportunity for an earnings trade. So you want to remember the goal is to take advantage of that temporary rise in volatility, as well as what a specific stock has done in the past, and looking at those probabilities to see if we can identify, you know, some things that are typical that tend to happen, some tendencies that we can go back and use. So there are kind of three type of earnings cycle trades that you can also look at. So first is a trend trade into the earnings release. So remember that as we go into earnings, the week of earnings, the implied volatility is going to start increasing based on all that uncertainty coming in, based on those call buyers, those put buyers. So it's going to drive up implied volatility. So that's going to happen. All right. So we can take advantage of that. We'll talk about it. And then there's the second type of trade, which is the earnings trade or earnings release. So it's a non-directional trade, because we don't know what the, you know, price will do. Will it go up? Will it go down? So there are a number of different strategies that we can put together that it doesn't matter on the direction. It's just going to take advantage of volatility collapse. And then there's the third type of trade, which is the post-trend trade. So a number of stocks a lot of times will have a post-trend trade. So, you know, they may have a great earnings and then they'll fall through to the upside, or it could be bad, they can fall through to the downside. So we'll talk about how we can trade and, you know, take advantage of that as well. So here's a really good example of these three types of trades. So this is on CRM. Now, trade one is a trend trade, trading into an earnings, and you can see this is the volatility trending higher. So in this example, you can see CRM is also the price is trading up. Okay, so the price is trading up, but also you can see the implied volatility in this teal, this blue line, is also trading up. So what you're going to want to do in this type of you know, pre-earnings trade is you're going to want to play the trend on price, in this example, to the upside plus implied volatility. So we're going to get, you know, so here, let's say you went long here, you're going to get the advantage of the delta increasing, right? But also when implied volatility goes up, that increases the price of the option. So you get the price going up, plus you get the implied volatility going up, and that's increasing that option price. So what you're going to want to do in this situation is, if you're going to play a pre-earnings move, you want to buy options, either calls or puts, in the week of the earnings release. So you'd be buying this series here. That would take advantage of your price going up and implied volatility going up. All right, so but you want to get out of this thing before the earnings release, because you don't know what's going to happen. So that's kind of trade one that you could do. And so there are a lot of these different ones and different stocks out here that will have that tendency. And then trade two is the actual earnings release, non-directional type trade. So this is one you want to set up to take advantage of that high implied volatility that you know is going to collapse after earnings. So a number of different strategies we can do there. So you can see here the earnings were released the day before, and then the price spiked up and pulls back. And then you can take advantage of that with non-directional strategies. And then trade 3 is a potential for any kind of post-earnings trend. So in this situation, you see that it opened up and then it closed up here. Actually, it was right here. And then it trended up after the earnings release. So we can take advantage of that with a number of different ways and strategies. All right, so these are 3 really great opportunities. And sometimes you may have a stock that gives you, all 3. In this situation, CRM actually had all 3 of those. Here's just one more example. Here's like Nike. And you can see here in this example, Nike, actually the price is trending lower, but as price is trending lower, what's happening? Implied volatility is also trending higher. And then also after the earnings release right here, price spikes, actually price goes lower, but also implied volatility collapses. And then here you can see implied volatility is going up, and here you can see prices going down as well. So you can go either way. In this situation, you may have been long puts going into the earnings or put spread, and then you can see the implied volatility is making those puts more valuable as well as it's trending towards that earnings release date. So these are things to be aware of and, present opportunity. So step 3 is we want to use kind of what I call a pre-earnings checklist. I like to try to systematize things as much as possible for any kind of trade setup process by, making it more systematic. We're taking our emotions out of our trading, make it more mechanical, okay? So that's always a good thing. So make everything you do as systematic as you can. So what we're going to look for in this checklist is we want to look for high probability stocks. So first off, the stock must have options, a good option liquidity. And then we're also looking for, a couple of different things. We want to look for stocks with high pre-earnings volatility to take advantage of. And so what we'll do there, what I'll do a lot of times is I do a scan where I'm going to scan every, stock in my database, and I can look for a scan that'll be based on a couple of different things I'll look for. So stocks that have been greater than 5 or plus or minus 5% over upcoming earnings season over the next 60 to 90 days. And then another scan I like to do is look for stocks that have had no more than a 5 to 7% move, max move over this period of time frame. And I like to then look back at about the last 4 cycles to see if this has been a consistent pattern for a specific stock. So 3 to 4 cycles, that if like let's say a stock tends to have a bigger move than 5% up or down over 3 to 4 cycles, that tells you a tendency that stock has a potential to spike. Or if you see a stock that doesn't have much movement, maybe caps out at 5 or 7%, that's a stock that we can look at for other types of earning strategies, just to maybe sell volatility in time. And then I also like a stock's kind of a minimum to start looking at is a $30 per share on up. So if you get too low on share price, there's not enough price movement for dollar per share kind of movement to take advantage of. So these are things that will go in the scan, and then that will put together a pretty good list that we can start from. So then the next thing is to calculate the implied stock move the day of its earnings release. When it's coming out, we want to know what the expected move is. Okay, so in that NVIDIA example, you can see the market was looking for a move of maybe $17 up or down, which was just one standard deviation. It could be bigger than that. So we want to know what that potential move is going into the earnings release. So then that will give us, information that we can then use for setting our price targets. And then once we set a price target, potential target up or down, that'll help us to, select the appropriate weekly option strategy to use. Then we have our entry plan set up, exit plan, and then place the trade if it looks all the things are lining up. So you want to be very prepared, so kind of have this kind of systematized checklist. So here's an example of kind of how I'll look at this analysis. So here's Roku, and like NVIDIA, its earnings. A lot of these stocks will always have their earnings on specific same days. So with Roku and NVIDIA, they're typically on a Thursday, and then that gives you, the expirations the next day. So in this example, you can see Roku here was traded at 137.50, 1 day till expiration. Look at the implied move, the implied volatility here on that option series, over 200%, huge, right? So the expected move would be that it could go up $16 up or down. And that is just one standard deviation, and it could go higher than that. So you can see Roku is over 200%. Now, normally it's maybe, 70 or 60, right? So huge, 2 times the norm typically. But this presents a couple of different opportunities. Number one, high implied volatility that potentially maybe you sell, and the other is potential for a big price spike. So that's Roku the day going in before the close, and before the close, and then the earnings are going to be released after the close. So you can see that uncertainty spiking that up. And then the next day, look where it is. Next day, it totally collapsed back to kind of the normal range. Now it's collapsed down to 127, and the implied volatility collapsed back to 73, which was kind of the normal range. So in this one, you can see volatility collapsed and price collapse of 7% to the downside. So a number of things potentially we could do there to take advantage of both of that scenario. So here's kind of some information I'll look at just to kind of show you the data. So here's Roku. So this is showing the implied move history, okay, as it approaches its earnings release. And so you can see this is what we call the straddle cost, which gives you this implied move. So in this example, you can see here it was trading before the earnings release, the close of that day, it was trading at 165, and the implied expected move, theoretical move, was that Roku for the next one day only could go up 10 or down 10%, plus or minus 10%. And then you can see the series before that was, it was trading right here, expected move up or down 11, series before that, etc. So you can see this has potential for really big moves, okay? So that tells you, okay, what are we going to do with this one? Well, it has big potential price spikes, so maybe we'll play this for a big price spike up or down, all right? So then I want to look at to validate that, okay, that's theoretical, but what did it actually do one day later? So looking at this data here, you can see then one day later, it was down almost 7% at the close that day. That'd be the Friday the next day. The series before that was down almost 8%, down 6%, down 16, up 20, up 28. So this tells me a lot about Roku, what to do or what not to do. All right, so this tells me one idea would be, hey, maybe we should do some strategy where we play it for a big price spike and not risk selling implied volatility where we could get run over and crushed. All right, so then you just kind of look at it a little bit more in depth, and you can see here, here's the history. So this is over 8 cycles in this example, just going back 8 cycles. And so here's the implied expected move history, going in. So you can see I averaged that out over these 8 cycles, and the expected implied move was 14.5% up or down. Now, the interesting thing here is if we look at what did it actually do, you can see it actually exceeded that. So it was greater than 1 standard deviation on the average. It was 16.7, either up or down. And then I like to look, okay, what was the worst case scenario? So in this example, you can see the smallest move was right about here, 6.32%. So then think about it. So if you could do a strategy where you set something for, okay, at least it moves up 6% or down 6%, and if you can make that even less than that, then you've got a pretty high probability winning trade. So for example, if the lowest move here was up or down 6%, it was down 6%, what if we could do a strategy where we could set a trade up for all it has to do is move plus or minus 5% up or down? Then we're inside that. That's pretty high probability trade, right? That's a 100% potential winning probability trade. So that's something we'll look at. So this gives you these kind of opportunities, and then you just have to think about, how to trade it. All right. Now the next thing is the power of weekly options. So I like to use weekly options on all earnings trades. So this is done to take advantage of, the 2 main option pricing components, which is time decay or time value, and the implied volatility. So it's the combination of these 2 pricing components, when used correctly, will help to create a very low cost, defined risk kind of trading formula to use for generating high returns on very short period of time type of duration trades. So it could be, these things can be like, lightning in a bottle. I mean, you can have some really big, exciting big movements over a 1 day period. And so, you can model that up, and if you can repeat it each time, every earnings season, then you've got something really potentially to work with. Now, so then it comes down to knowing which weekly option strategy to use for the earnings trade, then how to construct the trade, and then when to trade it, which one to use and then when to trade it. So these weeklies then can, really produce some exceptional fast profits due to the incredible leverage they're going to provide, and they really become kind of the perfect trading vehicle if you're going to trade an earnings type of trade during the earnings season. So, a lot of traders, needless to say, when a new earnings season comes up, it kind of is a paralyzing kind of part of the season for trading, because there's so much uncertainty. So a lot of times you're not sure, well, what should I do? You end up sitting on the sidelines. But today I want to share with you a number of different ways that you can, jump in and take advantage of all this potential opportunity that's out there for you. So how's this done? Well, then first thing I do is I look, I have a number of different strategies, and then what I want to do is do what I call comparative option strategy analysis. So when constructing the earnings option trade, we want to look, or any trade or any investment, you're always going to look at your risk to reward or your return on capital of the various, things that you're looking at. For if you buy a house, if you buy a company, whatever it is, we want to look at our return on capital. And that's the first thing we want to do. So we want to look at where's the potential that this stock could go up or down, that price target. And then based on that, we can back into a potential risk reward based on the different strategies. So then we'll look at the strategies, we'll look at the risk reward on the various strategies, and then you can collect, or not collect, but select the one that may be best suited, for the environment you're trading, and also for your personal, kind of risk reward profile. So what I've come up with and basically look at, there are 5 different strategies that you can use to capture profits from this extreme price volatility that surrounds every earnings season. And each strategy works best on certain circumstances. So we're going to talk about these 5 different strategies. So these are non-directional earnings option strategies. Okay, so non-directional to play an earnings release, and then maybe even potentially after. So there are kind of 5 that I'll look at. One is called what we call the short iron condor spread. So it's actually this spread, the structure is actually structured as a debit spread. And this is structured for big price spikes. So, in the example, like maybe NVIDIA or Roku, if there's a tendency for a big price break up or down, maybe greater than 5 or 6%, then we want to trade for a price spike, not selling implied volatility. You might get, crushed by, selling at an implied volatility level, and the price goes through it. So this is a really good strategy for that. So we'll take a look at that. The next one is what we call the long iron condor spread, which is actually the credit spread. So this is set up where we're selling time and volatility, credit spreads, right? So we're basically playing that volatility crush. Now, another one that does this is also what we call the long iron butterfly. Again, it's a credit spread. So this is also potentially used for selling or taking advantage of that volatility crush. All right, then the next one is a really favorite, which we've really gotten into. This is what we call, I kind of nicknamed it the double lightning. So it's actually a debit spread, but the thing that's great about this, I call it kind of the flexibility. It has potential. You're going to take advantage of volatility crush plus any potential post earnings trend. So this is a great strategy for that. And it's a very, very low risk, very, very defined risk strategy. So when you look at this particular strategy, and then you look at it relative to doing it the iron condor debit spread or the credit spread or the butterfly credit spread, you're probably going to always come back to this in the perfect scenario. This is going to be the highest winning probability and lowest risk type of trade, giving you the highest potential return. So it doesn't necessarily mean you're going to need to do it every time, but you're going to probably really like the parameters of this one and how it works. So we're going to go through this one. And then the 5th one is really great for trading up post-trend. So this is going to be an earnings pairs trading strategy. So if there's a good potential after an earnings release, there's a good catalyst for driving the potential price of that specific stock up on a trend or down, we can trade it with this kind of non-directional delta neutral pairs trading strategy. So we'll go through that. So these are some really great ways that you can kind of really take advantage of your earnings season. And, you know, out of all the different strategy 5 here listed, there's probably one that you're going to identify with that you think, hey, that's a really good one for me. Now, before we get going too much further, I know it's Easter weekend and some of you may be taking off early. So next weekend, I am going to have an earnings workshop specifically on these strategies. Okay, so it'll start next Saturday, the 6th of April, and we'll start at 11 a.m. Eastern to 2, and then we'll finish up Monday with from 4 to 5, and we'll have a Q&A after that the next day. So let me give you the link, and then you can check this special offer out. And then if you do need to take off, you're going to have this opportunity. So the course that I'll be providing or sending out and offering will be $197, and we'll go through what this is in a little bit. But there's what I call course package 1. So this includes a lot of different really nice bonuses. But if you use today the promo code, which is EARN, small cap, EARN, EARN 15, put that in the promo code. I'll show you where to do it. You're going to get 15% off, so you can buy the course today for $167. And then my course package 2, if you want my alert service, we'll talk more about this later too. This alert service is $597, but again, if you use that code EARN15, you'll get this, and this will be for 4 months. You'll get this for $507. Now, the alert service package will come with everything in package 1, all the bonuses, the live course, the recorded course, etc. But in addition to that, you're going to get my 5 different alerts for the next 4 months, and also my trading club for the next 4 months. So take advantage of that, and let me pull the link up so you can see it real quick, and then we'll move on. So you should be able to just click on that link or copy and paste it, and then it's going to pull up. It's going to pull up this sales page, I guess. And so you can see capitalize on your earnings, uncertainty and volatility, and use again small cap, EARN, EARN right here, 15. And you've got until the rest of the day if you want to take advantage of this. So here's just kind of everything you'll get. I'm not going to spend a whole lot of time right now because we've got a lot to cover, but I'll talk about this more in a little bit. But you can see here just kind of a basic summary here of everything you're going to get. So access to the class, 4+ hours. Now the price is $197, but again, if you use that EARN 15, you're going to get this for $167. All right. So actually, right now it's 86% off, but you're going to get a bigger savings if you take advantage of that. So you'll get the bonus 1. You're going to get my 4 hours on-demand course. Okay. So then you're going to get also my start trading options today. You're going to get that. Now this actually this on-demand is going to be just a course that's really going to be focusing all these different strategies, and so you can get started ahead of time, right? And then we'll get into the next Friday we'll get into the live portion, but this will get you going right away. And then for everybody that signs up, you're going to get a 30-day trial membership to my trading club. If you stay on, then it's $97 a month, or we have other packages. Then we'll do a follow-up Q&A, live and recorded. And then you're going to get another thing, how the Greeks are used. So just beta, delta, gamma, things like that. And then I'm going to give you my trade list of the kind of 3 trade lists of the best earnings. So scans that I do. And then in the course, I'll teach you how to do these scans. So you can see the total bonus value here is over $1,000. Now with the course, everything's about $2,400, and so the actual course price will be $197, which is 92% off. But for today, you're going to get it even at a better price of $167. So that's everything there. Just kind of a quick review. Then we'll go in more detail. And then package 2 will be the package 1, but with the alert service. So this you get my 5 trading alert services, and you can see my year to date we've had since I started these services, we're 79% winning rate. This is unaudited, but this will just kind of show you a summary there. And with this, you're going to get my 5 different alert services, which we'll talk about more. And then you'll get everything, in the package 1. So if you want to take advantage of this, just go click on Buy Now. And then when you come down here, you'll see everything listed. To get your discount, you'll just put in small cap EARN 15 right here, click apply, and it'll drop your price to 167. All right, so you do that, and that'll get you going on that, and then you can do the same. If you want the alert service package, just do the same. Just come down here, and you'll see here course package 2. Click on that, and then put in that promo code. Remember, small cap EARN 15, and there's a 2-pay if you want it, and then hit apply, and you can see you're going to get that discounted price. So wanted to go through that, and then let's move on. So here's the link again, Charlie. It's powercycletrading.com/special. Right up here, you can see special. Just put that in, and there you go. Now let's go through the first one. This is a strategy that's a really great one for really explosive price moves. So you probably noticed this past earnings season that all the anything AI related had huge spikes. So this is a way you can play these spikes on a non-directional basis. So this earnings season, everything was spiked up. What's going to happen this season coming up? There's all this price movement. All these movements to the upside have been built in. So it could be the opposite this certain season. We could see big price spikes up or up, but also we might see some of these stocks have big disappointments and spike down. So this is a great strategy for playing spikes. And so this is what's called the Iron Condor debit spread. And here's an example on CRM that we talked about earlier. All right, so here in this example, you can see going into this, CRM was trading at $230 basically, and then the option expiration was going to be 2 days later on the 1st of December. All right, so the exit was here. It was trading then at 260. See, it spiked up, went from 230 to 260. So this was a spike of over 12%. All right, so here it was, on the close, and so then earnings come out, right, and then the next day it spikes up here on Thursday, and here's where it closed on Friday. Now, in this situation, this is what I talked about earlier. Implied volatility always goes up, but sometimes you're not going to be able to sell implied volatility because you get these kind of spikes. So typically, if you sold, like, say, a 1 standard deviation move on NVIDIA, the expected move was, say, 5%. So that would have been right here. You maybe would be selling short calls, et cetera, or some kind of credit spread there. It went straight through. So you would have had a losing trade on that. So in this situation, you're not going to probably want to do that. If you're going to trade it, you're going to probably want to do this. So let's take a look at what that is. So this would be taking advantage of big spike. So this is then selling up the Iron Condor, the Condor debit spread, and just kind of going through the steps here. So the expected move going into the earnings release was for, move all close to 5% up or down. The trade then was set for, all it had to do was move 3% higher at the close on Friday or 4% lower. So it's actually inside the expected move. See that? Now, the tendency for CRM is for pretty big price spikes on the average, and it did spike. It spiked up here to 260, so it was up 12.87%. So this trade was set up, you can see down below, this was then going out and buying the earnings series was the 12 January, the 1st of December was the expiration right here, 235, 237.5 call debit spread, and then it was buying the 222.5, 220 put debit spread. So it looks like this is what this basic trade looks like. So you're long a call, short a call, long a put, short a put, all right? So all it has to do in this example is if it moves and it closes greater than 3%, max profit. If it closes less than 4%, max profit. Now, if it closes between here, you've got defined risk. In this example, your risk is defined to the debit pay of 168. But if you get the move up or down, the profit here is $82 per spread. So if you did one spread or one condor spread here, your out-of-pocket risk would be $168, and your profit would be 82 if you get that move at the expiration. That's a 49% return. Not bad. Now these are typical. Your typical returns on this kind of trade will be typically 35 to maybe 50% like this. So and these are very short duration, either 1 or 2 days, maybe 3 days. So that's kind of what that looks like. So if you want to play these big price spike movements of NVIDIA, Marvell, Qualcomm, Roku, any of these stocks that have had these huge AI moves, this is a great strategy. And so here's what it looks like. Here's your risk profile again. So here you're long, basically if you break it down, you're long that 235, 237.5 called debit spread, $84, right? And then the other side of the trade, long the put debit spread, the 222 and at 220, $84. So your total risk here then is that 168, your debit paid. And you can see what happened here at the call debit spread side, blew to the upside. See, it went from 84 to 250. And then the put debit spread, was a loser, but you offset that with the big winner there. So your spread, ended up making $82 per spread. So you're long that call, short the call, long the put. The put side was a loser, but that loss of 84 was offset by the big gain here of 84, and the spread was 250. So it was trading right here. That was a really great trade setup. So that's where it comes back to those statistics, looking at the probabilities of what something has done in the past. Now here's one to play. Here's another way to play a volatility crush. So this is the opposite of just what you looked at. This is what's called the long iron condor credit spread, which maybe a lot of you do condors, right? But this is one to do for earnings. So this is one that was set up that we did on Apple. And so you can see Apple was trading here going in. It will have earnings after it's closed. So this was going into the closing on the 4th of May, and it was traded at 165.79. Expiration was the next day, and the implied expected move was that Apple would be theoretically up or down 4.21%. So what we're doing here, we're going to sell a credit spread. We're going to take advantage of that potential spike in implied volatility. So just kind of, for example, here you can see 1 day to expiration, it was trading at 165.79. We were going to be selling this example I'll show you next. We're going to be looking to sell the credit spread side with the short strike of 175. Now the implied volatility on this 175 strike going into it at the end of the day was 61.41%. So that really spiked up, okay? So maybe write that down. So 61.41% just on that 175 strike. And then we're going to take advantage of that crush. And then so you can see the next day, Apple is trading here at 173.57. Okay, and you can see that 175 strike now has collapsed down to 9.5%. So went from 61 and collapsed down to that. So that's what we're going to try to take advantage of, and you can do that with the iron. One way is the iron condor credit spread. So here's kind of what it looked like going in. So it was expected move was for 4.21% up or down. It actually closed up 4.6. Okay, so it's trading right here. Going into the earnings, you can see the implied volatility had moved up, which will always be the case. And then this had a pop to the upside, up 4.6%. Okay, so what we're going to do here is we're going to do an iron condor credit spread where we're going to set it up greater than 4.6%. So typically, if the expected move, let's say, is like here, 4.5, I'll try to set these up for maybe, you have to look at the math and see if it works, 5.5, maybe 6%. And at some point, it's not going to work. It's not going to give you enough credit to make it the risk reward that you want. But here's how this one was set up. So this was set up for a movement of plus or minus 5%. All right, so you can see here, expected move 4.21, trade was set up for a price movement of not greater than plus or minus 5%. All right, so went out and sold the 175, 177.5 call credit spread, and then on the other side, because it's non-directional, sold the 157.5, 155 bull put credit spread. Those two credits combined were $60. Credit profit, which would be your profit, and then your risk is 190 between the spread risk of 2.5 less your potential profit. So this would be a profit of $60 per spread or 32% return in one day. So these are typical, and credit spreads in general, that's kind of typically what you're looking at on that kind of trade. So again, it comes down to the statistics and looking at past performance. So here's the trade setup. So this was, setting this up the day before the earnings were released, or that day of earnings release. So this was selling that credit spread here, short the call, long the call out here, 5% up on that, and then short the bull put credit spread 5%. And so if it goes out between the two spreads, that's where you keep your credit, which was a total of $60. All right, so you have that credit of $25 on the call side and 35 on the put side. So there you are, and then your risk is the difference. So that's a typical iron condor credit spread for selling volatility crush. All right, so you can see what the risk reward is on that. Now here's a favorite. So this is kind of the go-to strategy due to its low risk reward and what I call flexibility. And what that flexibility is that you with your typical earnings trade, non-directional, is just set up for that event into the end of the week, into expiration. But with this double lightning spread or double calendar, if you want to potentially trade a post-trend trade, it gives you that opportunity the way this structure works. So we'll go through and I'll show you how it works. So the reason this is so great is that, number one, it's very low risk. When you compare the risk to this versus, say, the credit spread or something like that, you're going to see there's always going to be less risk. And it's non-directional, okay, so we can use this for the earnings release. So low defined risk. Now, the other great thing, it takes advantage of that high pre-earnings implied volatility, the way it's structured, because what we're doing is we're buying a kind of a back longer duration option and selling closer in. So we'll go through how that works. So basically, then that sets you up for selling time and volatility is what we want to do. So that's going to profit then from any volatility collapse, which there will be always. And then also, this allows you to profit from any post-earnings trend if you want to, because you're going to be long. Your long dated is the next series out, or a couple series out if you want to structure it that way. So with this trade duration, it could be 1 day up to 1 week, or you could make it even longer. It's always a positive theta, no time decay. So what sets this strategy apart from the others that also sell volatility is that it can be adjusted again into a directional trade after the earnings release, providing you profit for big profits from that post-earnings trend. So we started using this with my alert service back in 2020, and we've had really consistent, really great results using it. So since combining that back in 2020, these are very selective trades though. We don't do a whole ton of them, but you can see we've had 120 trades closed out, 87 winners, 14 break even, 19 losers. So 84% winning rate on these. These are unaudited. All right, so here's an example. This was on STZ. Okay, so non-directional, low risk volatility collapse earning strategy. So just kind of going through the steps here, you can see that STZ, this is kind of looking at just the past performance over 4 cycles. The earnings are the earnings, and this is before the market opens. So typically your earnings will be after the market closes or the day after before it opens. Okay, so this was going to be the day after before it opens. So you can see it's going out here, trade at 242, etc. Straddle cost here. So this gives us our expected move. So looking for STZ, 3.5% up. You can see it's very consistent around that level. Now, what I always want to do, then what did it actually do? So now I look down at the 1 day later at expiration. Well, it didn't have a big, huge move, only up 2%, down around 3, flat, 1.44. So this is not a big mover, so this is a great potential stock to trade for, volatility collapse, or maybe there's a post-earnings trend after it. So one way to do this was then using the double calendar or that double lightning. So here it was going in, just kind of looking at what it was looking like. It was trading at the 242 expiration the next day. So the next day it was at 242, next day it was at 247. So the expected move was 3.5% up or down. Trade was set for a 3% up or down move. All right, so it's trading right here. You see the implied volatility collapses. And so we were able to take advantage of this, doing this double calendar. So how do you get the earnings history? We'll talk about that here in a bit. All my statistics. That's the biggest, really the big part of your success for these trades is looking at the stats. All right, so a good question. We'll talk about that. So here's STZ going in. This is before the open. So the setup was to set this up the day before. Okay, so the earnings are going to be on the 5th before. So we need to set this up on the 4th. Okay, so on the 4th, it was going out trading at 242. Option expiration was the next day. So you can see here the elevated, this is what we call positive implied volatility skew, is 86.45 in this series the day before the release, and then you can see typically on average, it's more like 30% or 25, right? So it's spiked up, which all these will have that implied volatility spike that we take advantage of. And then the next day, you can see the price had moved up, but the implied volatility had collapsed back to the kind of a normal range. In this example, back down at 27, etc. So here's the trade that we did. So this trade was then doing this double calendar where we were going to go out and we set this at 3% up, 3% down. So bought if you look here, bought the earnings expiration was going to be that 5 Jan series on a Friday, 5 Jan. So what we did was we were going to be short, basically you're long the week behind at the 12 Jan and short the 5 Jan. So there's your short. So this is what we're selling time volatility, but we're long the week behind it. So what this does is that we can sell time and volatility, but if we did want to stay with this trade for maybe a move up, if it starts to trend, then we still have that 12 January, the next week out, that we could stay long with. Okay, so we're doing this as a calendar, so that basically what we're doing is we're selling the 5 Jan, which is the short duration, like 1 day to expiration. We're selling 247.5 strike, and then the week behind it, we're buying that 247.5 strike. So we're getting this at a 75. Look at the debit cost, 75 bucks. That's the max risk on that part. Now, we don't know if it'll go up or down, so we're going to do the other side as well. So we're doing the upside for 3% here if it moves, and the downside for 3% if it moves there. So the put side was right here, doing the 235 put long, short that 5 Jan 235 put. And that too was at that point 75 bucks. So the total debit cost here was that those two debit spreads. So $150 is your max risk. And then your max profit is going to be if you hit your target. In this example was 3% up or 3% down. So at 3% up, it did actually go into here 3% up, and this was up, $180 on that risk of 150. So it went from, if you look at the spread, it went from, see, it was trading at 293, the call calendar side, and the put calendar side had gone down in value to 38. So the total spread now was at $330. If you take the 293 plus the 38, that's 330. Your spread cost was 150. So the difference is your profit per spread. So if you did one spread, in this example, you would have been up $180 or 120% return. So think about this versus the credit spread, where your return was going to be anywhere from maybe 30 to 50%, but also potentially bigger potential loss. So every time you look at risk reward, I always keep coming back to this one because it's the parameters are so much more in your favor. Now, the downside to this is if it goes out in the middle right here. So this all depends on what we call skew. So next weekend, I'll be teaching you what that skew is. And so even if you do go out in this example, you can see it right here, this kind of trough right here. So even if you were to go out here, it didn't move at all. You can see here's your zero line. That's your profit and loss. So even if it did go out here, you're still going to make a small profit, or it might be a break even. So that's the thing. It's so forgiving. So the worst case scenario in this example, that's your break even right here. So the break even in this example on the downside was going to be, it would have to move down 5% for this thing to break even. And then what you can do is we'll go back and look at history, and you'll see that SPX has a very, very low tendency to ever move 5% lower, or the break even on the upside is 4% here. So this gives you just a great risk reward parameter. And then you can see it anywhere in between here. If the skew is right, you'll make a profit. Now, if you hit it perfect, you can make a really big profit. If it goes out kind of here, it'll be a little bitty profit. But the point is, you're not losing, and you can just keep doing these trades. So they're pretty cool. And then if you think it's going to trend, what we'll do is we'll leg out of the short call side, leave the long call out, close out the put side and let it trend up, or we can do the opposite. So it gives you, that's what I call the flexibility. So it's really cool for that. Now here's another one. This one, you're going to be amazed at how cheap these things can be. This was another one, double calendar. This was on CL, okay? So looking at the earnings history for this one, you can see that going back 4 cycles, it tends to have very small moves, 2.83, 3%, 3%, 3% expected move history. Okay, and then what does it do a day later? Well, it doesn't have a huge move. Here it was over, just looking at 4 cycles, here it was almost about 2%. Here is a little under 2, 2, 2. So really consistent here. So this is a really good one for maybe setting up this type of trade. It doesn't have huge moves, but we know that implied volatility is going to be typically bigger than what it normally is, so we can take advantage of it. All right, so this was set up for that situation. So it was trading here. Colgate was trading at 80.96, and then you set this up the day before the earnings expiration. The earnings were going to be before the market open on the 26th. We set this up on the 25th. And so on the 26th, though, now it was trading at 82.83, so it closed up 2.3%. Expect to move 2.83, set the trade at 2.5% up or down, all right? And it closed up 2.3. So this worked out really perfect. And we had that implied volatility. Plus, look at this. If we had wanted to, look at the trend, we could have stayed long the call because we're long that the next week out. All right, so here's just to kind of show you that implied volatility skew here, just the going in, it was trading at 80.96. So here's your Jan 26. The 83 call was going to be the short strike for the calendar here. You can see the implied volatility on that strike was 46 going in the day before. And then you can see how this collapsed. We take advantage of that spike, and then the day after, that 83 call is collapsed down to 14% implied volatility. So we're taking advantage of that. Now look, this is going to be just blow you away how cheap these can be. So in this one, the setup, this thing cost $17 for this spread. Okay, so this was going to be long. The set up for 2.5% up or down. Okay, so set this up. It was trading when it was trading 80.96. Set this up for the 83 calendar here. So long the 2 Feb 83, then short that day expiration at 26 Jan 83. That was going for 11 cents or $11 debit cost. $11. That's all. And then the put side was actually cheaper. So here's the 79 put. So long the 79 put in that 2 Feb and short the 26 Jan 79, $6. So these can really vary. So the total cost of this was 17 bucks. Now, this ended up going out. It was trading here on the 26th then at 82.83 right here. And so this thing had gone almost perfectly to our target right here, which was the 83 strike. So it was trading at 82, 83, very, very, almost not perfect, but almost perfect. And so this spread, then you can see, went from, it was now trading at the call debit spread side was now at 53. The put debit spread side was at 0. So here's your profit. So the spread had blown out to 53 less your cost. So that, not a huge fortune being made, but look at the return on this for one day, $36 per spread. That's a 200% return in one day, just plain implied volatility, collapse, and time. And then on this trade, if wanting to, you could have just stayed with the trade. We could have closed out any short call in the put side and just kept the long call in that 2 Feb series for a move up. So that's the flexibility that it offers. So really, really great structure. Now the next one is what's called the earnings pairs trade. So this is a market neutral post earnings trend trade. So if you want to trade a post earnings trend, this is a really great way to do it. So when we look at pairs trade or spread trading, it's a market neutral strategy that you can use to trade post earnings trend on a stock after its release. So trading pairs or spread, what it does by doing these pairs or trades or spreads, it helps you to mitigate overall market risk. So by simultaneously taking opposite positions on related securities, then allows you to reduce your exposure to any broad market movement. So we don't care if the broad market goes up or down. We're just playing the strength and weakness between two securities that are correlated. And it's perfect for earnings, because earnings provide the big catalyst for that spread to be either very, very strong or weakened. So in other words, a pairs trade is going to be equally profitable whether the market you trade goes up, down, or sideways. It doesn't matter. What matters is the strength of the spread itself. And so we can do this using what we call synthetic option structure, which you'll learn how to do that next week at the course. So the cool thing with a pairs trade is that, let's say, I'll show you a couple examples here. One will be, we're going to be long QQQ, and we're going to be short actually Apple. All right, so think about how you can make money 5 different ways. So let's say the QQQ goes up faster than Apple. All right, so QQQ goes up, but Apple goes up, but not as fast. So you can see that spread widening, right? So you're making money. Or the long, let's say QQQ could go up, but the short moves sideways. So QQQ could go up, and maybe Apple goes sideways. So you can see that spread widening, so you're making money. Or the move sideways. So you can see that QQQ could go sideways, but maybe Apple declines, right? So you can see that spread widening. Or you can see QQQ declines more slowly than Apple. So QQQ could be going down, but Apple can be going down more, and that spread widens. Or you can see QQQ goes up and Apple goes down. So it really widens. So you've got basically 5 different ways that you can make money, versus if you're just long, or let's say you're short Apple, you can only make money if it goes down, and if you're long, you can only make money if it goes up. But this is a kind of pairs trade, and you're neutral as far as overall market risk. So pairs trade then can be structured. We can do it using a synthetic pair structure, which you're going to learn next week. So where your long and short options to mirror actually the underlying stock or ETF that you're using. So this will overall lower your cost of your trade, and also end the hassle if you have to borrow shares, which you won't have to do. So here's just an example of 2 different situations. So Apple's been a really good one for pairs trade. So here's Apple, and here it was trading. Just you can see the price of Apple on the 4th of May was trading right here. Okay, so it's trading here at 165, and then it had a really good trend to the upside. Okay, now here's the next one we'll look at. Apple was trading here at 191, and it had a big move to the downside. All right, so but what I'm going to show you is how this setup was traded after an earnings release, where actually QQQ Apple was less strength than QQQ, which is Apple is kind of highly correlated to what the QQQ NASDAQ, right? So we're looking at that correlation. So with this pairs trade, this was perfect for using the strength and weakness. Actually, Apple went up, but QQQ was going up stronger. So just kind of bear with me. So here is the spread on the 4th of May. Now this would be like your long QQQ and short Apple. Even though Apple was going up, QQQ was actually going up faster and harder, had its relative strength was stronger. So here the spread going in on the 4th of May was right here. It was trading at $152. That's QQQ was $152 per spread above Apple, okay, right here. And then the spread was on the 18th of July, was now that spread had widened out to $191 right here. So that spread, the relative performance between QQQ being stronger than Apple, had a peak right here on the 18th of July. Now it was trading at 191, that spread. So if you had done that just as a pure spread, you can see what your potential is for this trade. Now there are a couple of different ways you can do it, but just the long and short is, if you look at this spread went from 152. If you did one spread where you're long QQQ, short Apple, and then it went to this 191, that was up $39 per share, right? So we do this using synthetic options. So if we did one option contract equivalent to 100 shares, so this would theoretically, you would have made times 100, this would be a $3,900 per spread profit, okay? So that's you know how that would work. Now here's another one. This was on the 3rd of August. It was trading here at 183. So at that point, QQQ was $183 over Apple, and then you can see what the spread did. So you can see it peaked out here, came back down, and then it hovered, and it went back up, and then it went from 183, and then on the 14th of September, it was trading. It peaked out at 201. So here the spread went up. That's $18 per share, or per option contract. If you did it synthetically, you'd be up $1,800. So there are a few more things to it, but that's just the kind of the raw, you know, overall what you can look at. And then we do, you know, different. We can weigh the you know, if the QQQ is more, we'll do a weighting of maybe we buy, you know, one or two Apple. You know, I'll show you how to do that in the course. Versus, you know, we try to make the ratio as close to 1-to-1 as we can. So that'll be shown to you in the course. Now here's just another good example. This is Nike. And so you can see Nike here on the 29th of June was trading at 113. And then it, you know, comes off hard. And then here's another one. I'll show you the spread. Here is Nike on the 28th of September. It was traded here at 89. So here's the spread, potential spread you could do on that if you've done this. So this was doing Nike, and this was doing it with a ratio where you're going to be, Nike's going to be on a dollar value basis equivalent to SPY. So it's adjusted for the dollar value. So here's Nike, and you can see Nike was trading here at that point. If you can't, it's a little bit hard to see, but it was at that point Nike was trading at, let me get my pointer. So this would be long, like short Nike and long SPY. So here was Nike was trading at $72 over SPY. And so then, so shorted Nike, long SPY, and here's the spread. So that spread then went from that point 72 over, look at the spread, it just collapsed. And now at this point, the spread was now at 14 under, all right? So that spread at that point in time, if you'd sold Nike short, it was trading at $72 over SPY. So Nike short, SPY long, and that spread narrowed in and actually went negative down to 14. So with this one, you would have, you know, just, you know, the exact spread movement was 72 plus 14. That spread had a movement of $86 per share, which would be, you know, if you did one contract, that's $8,600 per option contract if you did the spread. All right, so, you know, that's just to show you the potential there. if you do that. And this is based on the catalyst being the earnings. And so then you can see here, it was trading at this next one. You can see this was trading at $2.50 under. Nike at this point was $2.50 under SPY. And then the spread went the other way. It widened, okay? So it went to 250 under, and now right here, this yellow line, it was now at 81.5 over. So that's a huge move, right? So now the spread went to $81.5 over Nike over SPY based on that relationship. And it started out at 250 under, okay? So that's a movement of $84 per share, or 84 if you did this synthetically, doing long short with the options, you would be up 8,400. So I'll go through the course and teach you how to do that with the earnings being the catalyst. So these are some really great ways if you want to participate in the season coming up. It gives you a lot of different opportunities and things that you can do. Hey, thanks, MT. So these pairs are just, you know, so do you trade pairs in context of the earnings or independently? Yeah, you trade, well, you can do both. I mean, pairs trading, spread trading, you do this. You know, I've taught a lot of different members spread trading, and that's all they do now. But a really great catalyst for these spreads to move will be the earnings. You have to have some kind of catalyst to make that correlation shift. You know, typically you might have a correlation that's very, very tightly correlated, maybe 70, 75, 80% correlation, but with the maybe earnings, you could get that correlation to get out of whack for a time. And that's what we're looking at, that differential, you know, to play that spread. All right, so, you know, will every trade be a winner? It'd be great if it could, but no, they're not going to be. So what works is then using this synthetic approach then for finding the highest probability or systematic approach trades. And so again, what we're going to start with next Saturday is how to do this in great detail. So we're going to talk about more how you get started profiting from these high volatility earnings season that's coming up. And this will be using weekly options and pairs trades, etc. So what I'm going to be offering, I gave you that special here, and let's go through all the details of that, and then take, you know, any additional questions. So again, look there, use that. So with this workshop, we're going to start next Saturday at 11 a.m. Eastern to 2. Now it will be recorded, so if you can't make it all or part of it, or even if you can't make it at all, you'll get the recording. It's yours forever. And then we'll follow up with kind of part 2 on Monday at 4 p.m. And then we'll do a Q&A the day after. So this package here comes with 6 enrollment bonuses if you know, take the package. But the overall price of the course is $197. Okay. So the workshop, 4-hour workshop, my time and putting all this stuff together, I put a lot of work into it. So just based on the core price, you're getting this for 86% off. If you use that promo code, you're going to get another 15% off. So actually today you'll get this for $167. Okay. So question is, why use pairs trade versus trading an option as a hedge on the underlying? Seems that the pairs is much riskier. Okay, so here's the reason, Sandor, because, okay, think about this. Let me erase this. So if you, let's say you think, try to give you a good example. So let's think, okay, so in that Apple QQQ situation, let's say that you think, okay, Apple is going to go up, right? Which Apple did. Apple actually did. You know, that chart showed you Apple went up, right? Okay, so you could have bought just outright calls on Apple, all right? And but then what if Apple? But you know that it did go up. But what if you bought outright calls on Apple and you think it's going to go up? But what if it didn't go up? What if you bought outright calls on Apple and it just goes sideways. All right. So you're going to lose money, right? Because of the time decay. What if you bought calls on Apple and it just barely goes up, you know? Well, you might make money, but the time decay, depending on your duration, might wipe out all your potential gains because of the time decay. So if we do a synthetic long short by being long an option, short an option, that offsets any theta decay. So we're actually structuring the exact underlying of the trade. Now, when we do a pairs trade, the other benefit of this is, again, I talked about correlations. When you look at any stock, you can look at the ETF that it's in. So it could be like, it could be Apple as part of, you know, the big sector of Apple is XLK, right? Okay, now Apple, if you've been noticing Apple, Apple's really been underperforming XLK, QQQ, et cetera, right? So let's say Apple comes out and has good earnings, and so it does go up, but we could see XLK because XLK has also NVIDIA. It's got all the, you know, it's got all the different semiconductors, so it could outperform Apple in that relationship. So that could still not be a good trade. Apple could go up, but if you did it as a pairs, it could be much stronger. Plus, what if Apple was to go down? So what if then Apple, you thought it was going to go up, but it goes down, and you're long QQQ against it and short Apple, but the whole market goes down, but QQQ goes down less than Apple. Okay, so Apple could go down really hard, and then QQQ could go down very gradually, and so you can see that spread widening. So the harder Apple goes down, that spread widens out. So you make money on the spread. You're not making money just on Apple. You're making money on the relative spread between its correlated instrument of QQQ relative to Apple. Okay, so that's the beauty of a spread. So arbitrage, whatever you want to call it. So that's what hedge funds. The big money trades pretty much spreads because it's less margin, et cetera. So with this course, here's everything you're going to get. Course is 197. You use that link here I gave you, earn EAR 15. Remember to use that, small cap EAR in 15. Use that on your promo code, and that'll give you the 15% off. So with the course bonuses, you're going to get also my on-demand 7 hours earnings course that's previously done with all the different strategies that we talked about. So this is on my website, 297. You're going to get that to start with. Then you're going to get a 30-day trial membership. You can start it and stop it, or you can start it whenever you want. So you'll get that to start with right away, and you'll get that. Actually, that, yeah, I think this should have been 97, but anyway, then you're going to get my Start Trading Options Today as an options beginners kind of intermediate course. You'll get that right away to start, you know, really good to add to your option library. And then we'll do a follow-up Q&A the next day on Tuesday. So you'll have that. That'll be live and recorded. And then I'd like to give you my Greeks. I like to, you know, make sure that you have as much information on the option Greeks, option delta, gamma, theta. So it's a really good little option course there on the Greeks. And then I'm going to give you my 3 updated trading lists for stocks to trade for earnings. Stocks that move greater than 5%, 7%, or 5% max. So you'll get that. Plus in the course, you'll learn how to do the scans for yourself. So total course package value, I'm not sure if that, I think that's wrong, but anyway, total course package value is 1,035, and then plus the course, so your total package value 2,400, and then today 197. Now, when, you know, after today, when I go out to, you know, my list and everything next week, the course will be 197. But if you sign up today using that link, promo code link, earn 15 small cap, you'll get that discount. So it'll be 167. So hopefully you're, you know, take advantage of that. Now, if you want my Elite Open and Close Trade Alert service, this is package 2. And this would be a great service if you're, you know, needing more help and guidance in your trading. So, you know, let's say you're, you know, you can't sit at the screen all day and look. and you're wanting more trade setups that you're not able to find because you don't have the time to do it. Plus, maybe you don't know how to do it, right? So that's kind of something that I come in and will do for you. So with this alert service, you're going to get my 5 different alerts. Okay, so we'll talk about that. And you'll get these 5 different alerts for the next 4 months. Okay, and you can start and stop whenever you want. So if you go on vacation or you're off on business, you can stop your service so you're not wasting your time, and then start back when you want. Plus, you'll get 4 months to my trading club. All right, so everything here, and so everything in course package 1, which was $197. So you're going to get all that. And hey, thanks, MT. Let me pass that on. So you'll get all that. And then what you're going to get here, I've got 5 different alerts I sent out. Butterfly long condors, selective setups, calendar diagonals, what we call monthly butterfly calendar pinning trades. These are really cool. Breakout reversals or credit spreads, and then these selective earnings trades. So you get 5, it just depends on what I'm seeing, what's the best opportunity. And so you'll get that. And here's just the promo code again is EARN, EARN 15. Small cap again, right there. And then here's from MT. Appreciate that, MT. Pass that on to you. Appreciate that a lot, believe me. So here's from MT. So you get all that. And now, here are the specific links. If you want to, just a specific link for course package 1, course package 2, or it's easier, just you can use that Power Cycle Trading /special to do it as well. But here are the individual links that I'll show you here. Let me get that. I don't know why I did that. Hold on one second here. So let me get the individual links if you want to go specific links, which comes out to be the same by using powercycletrading.com /special. So that might be the easier way, but here's if you want to just use a specific link. So here's the for course package 1. Let me click that, make sure it's working. And it does, yeah. And then down here again, put that EARN 15. Make sure it's small cap. Click apply. And if you do want my trading indicators, you can get those as well as an add-on for $195. All right, so that's the link there. And then for the alert service, if you want this, here's just kind of the special link here. And there is a 2-pay, so it's powercycletrading.com /alert earn. And here's that link. And then we'll continue on. Okay, and there's that link. And then if you click that, it'll show you payment link here. Then again, use the promo code down here, EARN 15. And it'll list everything here that you get, so you kind of have an idea. Or the other way is just, again, use powercycletrading.com /special. Now this will not be, you need to use it today before time runs out. All right, so with this, you'll get the, basically with the alert service, you get everything in package 1, and 197, all the bonuses plus. So basically I send out typically around 8 to 12 stocks or ETFs per month. So it could be a specific butterfly or condor, long condor trade, or we do a lot of calendar diagonals. We do these, what we call monthly kind of pinning trades using butterflies or calendars. These are really cool. Breakout reversal trades, these are typically credit spreads, and then selective options, earnings trades, which most of these are going to be that double lightning. So when I do send this out, a lot of members just do their own thing. They just want the trades and they'll do it. They might just buy the shares or calls or puts or whatever, but I'll always send out a guide with the selective option, option strategy like above, okay, on any alert. So trade setup video review, I'll do that at the end of the day, kind of tell you why I did the trade, what we're looking for, These are archived. Then we're going to do with the alert service. You're going to get the trading club for 4 months, which gives you my weekly trading Q&As every week, live and recorded for the next 4 months. Daily market video newsletter. After the market close, I do a video update on what I think the market's doing, where we're headed, things we did that day. And then a big part of it is access to my virtual trading room, open every day during the week. And so you have that for the next 4 months. And again, you can start and stop when you want in case you go on vacation. And then you get a discount, 60% off all courses and software on the website, okay? So a really good package there. And we've had really good success on the alerts. All right, so again, here's everything here. Make sure to use that code here today and get the 167 if you do course package 1, or 507 if you do the alert service combined with it. And then let's go through the what you're going to get here. So again, if you look at my alert service summary here, since starting it, I started back in actually 2018. Wow. And then through Friday, we've had 717 trades closed out. This is a combination of all 5 of these services, right? And so it depends on, when the first service I started was just kind of breakouts, and then we've added to it, but just kind of an ongoing summary. And so we've had 520 closed out winning trades, 44 break even, 153 losers, 79% win rate. So a high win rate. Again, these are unaudited, just a kind of a summary win loss. And then on the earnings, these are very, very selective. We've had 120 closed out, 87 winners, 14 break even, 19 losers. Win rate 84% unaudited. Now here's what we're going to cover in the course. Okay, so we're going to start with part 1. This will be part 1 and 2 are going to be live and recorded. Okay, so we're going to start out with the 5 steps to the perfect trade setup. So we're going to go through the analysis, the tools I use there. So somebody asked, what are the statistics? What are the resources there? You'll learn in the course the statistics and the resources I use, and then how to use those statistics, okay? Then we'll go through kind of what I set up, a 7-step screening process that will identify the most probable type winning trades we're looking for. I want you to understand then how option pricing works to affect these types of trades using weekly options. My statistics, the secret resources there, earnings history for all these stocks. You're going to get all that. And then the big thing though then is how to use it. So then we'll use these statistics quickly we can set up scans, and I'll show you how to set up the scans I use, and then how, if you want to set up different scans, you can do that. And then how to analyze your stock's earnings release move and post earnings move, based on these statistics that we're going to use. And then my formula to create kind of your efficient watch list, these high profitability potential trades. So a lot of it is your homework of setting the trades up and doing your homework before the trade is even done. And then part 1 and 2, then we'll get into the actual trade strategies for this live course, which are going to be the Iron Condor Dove spread. This is going to be the one for price spikes, okay? We're going to go through that. And then we're going to spend a really good chunk of the course on the double calendar, or this is kind of the go-to because it's got such great flexibility, very low risk as well. Yeah, the secret resource. Yeah, the stats that I use there, it's like the service is like, well, I think it's like $14 a month, and you can stop it and start it. Like during an earnings season, you can start it. And then when you're not in earnings season, you can discontinue. But it's really cheap. But great statistics, okay? So it's definitely a plus, and it gives you a lot more than just earnings. It'll show you short interest, all kinds of really great stuff. So here's just a little bit, absolutely the best earnings strategy I've found, as well as the overall excellent strategy period, in my opinion. So you're going to learn in depth how and when to use this dynamic strategy based on a 10-step trading guide that I use. So this will cover, how to choose the optimum option strike price, how you go about doing that, how the structure is set up through option expiration, so ease and perfection. So these are, the steps I'll go through very detailed to show you, so you'll know exactly how to do the trade, how to do any adjustments if needed, so to the double calendar, So sometimes we're able to trade and set these up into a free trade if it starts to trend, where we have zero risk. So very, very cool. And that's, like I said, no kidding. You'll learn that in the course. And then we're going to get into, in the live course, we're going to go through how you can use the pairs trading strategy. So again, these pairs trade, I've been trading spreads for, basically that's all we used to trade, so I always traded spreads and never outright. So it's just a great way to go. So pairs trading or spread trading is basically a market neutral strategy that can be used for these kind of post-earning trend moves on your stock after its earnings release. So the strategy will totally change your trading game plan in favor of you during high volatility markets, regardless of market direction. So think about that. We've been in a really low implied volatility market. It's just been grinding up. But in the future, things will start. Something will happen. The markets will go crazy. So you may decide, man, these pairs trades are just the best because you don't have to have the direction of the market. You're just playing the strength or weakness between two correlated instruments. So they're really cool. So details then covered on these earnings pair trades will include how to identify and select the best earnings stock pairs to trade, what to pair it against. Then the statistical measurement of pairs trade correlation, how to measure a correlation. Is it correlated 70% of the time, 80, 95, etc. The resources that I use for that. Then when and how to set up the earnings pairs trade, and then how to lower your pairs trading costs using a synthetic long-short structure. So really great thing to add to your trading portfolio as well. The earnings history you'll get in the course. We'll go through how to get the earnings history, how to use the statistics, how to analyze it. Okay, so that's all going to be in the course. Okay. Okay. Then the second part or the third part, this is recorded on demand because I spent so much time in this course on those other three strategies, but I want to make sure that you see the other ones that you can also use. So this will be a on-demand part of the course that you'll get. This is recorded. So with this part of the course, you'll learn if you want to use the Iron Condor credit spread. Okay, the Iron Butterfly, you'll learn that, and then in this course, on-demand course, you'll also go through the Condor, but we're going to cover this one in the live course because a lot of these big stocks, a lot of the AI stocks have had these huge price spikes. So I want to show you how you can play those if you want. So then you'll get an option guide, each strategy explained in depth, how, why, and when to use. So all these are explained in detail with examples, and then how to construct the earnings trade based on your pre-earnings implied move. How do you calculate the implied move? A big part of it. So you're going to learn how to do that. How and when to set all trades up, how to manage into expiration, and you're going to get a nice trading library that you can go back and look at past trades to kind of get an understanding of how they work. So just kind of, going back, here's just an example of over 40 trades, Apple, Google, Baidu. These are all different earnings trades to show you. And here's just a little nice feedback from Mary. She said, this course explained in clear and simple terms how to trade options on stocks that were coming into an earnings release. Larry showed the specific sources of information he uses to determine which of the strategies is most appropriate for the stock that is reporting based on its historical data. He gave specific guidelines as to the use of each and also the exit strategy. Larry goes over the material in great detail and shows examples of the strategies for past performance. Now, one thing that impresses me with each of the courses I've taken is his willingness to repeat explanations and if someone asks for clarification. Larry scheduled the classes for a certain time frame, and because he wants to ensure each participant has understood the information, he most often goes over the planned time frame because he has to stop to answer questions. So yeah, typically, I'll set the course might be a 4-hour, but typically it ends up 5 hours or something like that. So it's an excellent, course, and you do have time to ask questions as you go, and then you can learn as you go. So pairs trade, show examples, pairs, diagram trade. Yeah. So yeah, so Wayne, the course will answer all of those questions. So here's a question from Wayne. So with the pairs trade, I'll go through everything that you're asking about as far as examples and how they work, okay? So not only will you then be able to use it for earnings, but you may decide this is the way you want to go for all your trades. So bonus special 1, you're going to get my on-demand 3-part earnings option course. So get you started right away. So this is a comprehensive, extensive 7-hour recorded program. So plus the PowerPoint over 428 pages, PowerPoint of the course. It's going to go through, covers all 4 of these weekly option strategies: the double calendar, iron butterfly, long condor, short iron condor. So you can get started right away. So it'll give you the option guide with in-depth explanation of each strategy, how when used with trade examples, and then how to maximize your earnings price spike using the short iron condor, or the right ways to sell volatility using the iron condor or long iron butterfly. So really great course to get you rolling with that. And then special bonus 2 is you're going to get a 30-day trial membership. You can start this when you want. You don't have to start it right away. You might wait till after the course or whatever. But this will give you access to my virtual trading room open each day during the week, 9:30 to 10:30 Eastern. So with this, you can come in, see what we're doing, ask questions. If you have a problem with the trade, come in and ask. I'll help you with your trades. Do a daily video market update every day after the close. Member trading videos are archived. Then we do a weekly Q&A, live and recorded every week. Got a nice Traders Educational Vault for everybody with good additional educational stuff for members, and a 60% discount. So you'll get a members code, and you'll have a discount from 6% off of everything on my website. So if you were, say, for example, you want to buy another course or trading indicator, you can go to the website. Let's say you want any trading software, come down here. You might want my volatility breakout scanner. You can come down here, and the price on the website is $397, but you're going to get your members code. You'll get 60% off that price. Or maybe any course. There's I've got every course I've got. They're all stock. They're all related to options. Option guide course, synthetic option covered call course I just did. So all these courses are 60% off with your members code. So really great stuff there. Here's a really good one from Jay. He said, just wanted to say my option knowledge has leaped exponentially since joining your trading room. Reading books is fine, but seeing the actual option trade makes a huge difference, Jay. And then you're going to get bonus 3, start trading options today. So this is kind of a beginner's option course, but it's a great one to add to your library. So if you're just starting out or you need a refresher, it's a good one. Comprehensive, easy to understand course that'll take you through the benefits of options versus stocks, tips that you need to know about options, the option basics you need to know, mastering puts versus calls, and then you're going to get 3 different strategies: the covered call strategy, protective collar strategy, and vertical debit spread strategy, and resources. So this is a trial, not trial, but a bonus course that you'll get. And then we're going to do a live follow-up Q&A. This will be probably Tuesday, the day after we finish the course, and then access the virtual trading room for your additional support for the next 30 days. Then you're going to get how the pros use the Greek. So this is a course, 60-page course with videos, just basically on delta, gamma, theta, your Greeks, option pricing, what I call market maker secrets, standard deviation, option delta, trade probabilities, how to use those. So it's just going to clarify all that in even more detail to you. And then here's a really big part too, and you're going to learn how to do this in the course as well. So I'm going to give you my 3 top earnings watch lists. So the best stocks to use for earnings season. So these are going to be what we're going to scan. We'll do a scan for these, and I'll show you in the course how to do it. But you'll get this scan. So it's based on stocks that have a tendency to move greater than 5% up or down, and then we do a scan for max 7 or max 5, etc. So we'll get you those right away, and those will be on a spreadsheet, so you can kind of keep track and build your watch list. So here's just kind of example of what you're going to be receiving. These will be updated, but this is kind of what it will look like. So here's list 1, the max 5%. So this will kind of list everything coming up over the next 90 days of the earnings that are coming up. And so it'll show you things that typically move, in this example, no more than 5% up or down, like J&J, ROP, Bristol-Myers, and then the markets close, average volume, the earnings date, when it is it after or before the market opens? So nice, this is what we'll put together in the course to get you started, plus you'll get this right away. List 2 is max move of 7%, so a little bit more, but this gives us a really good list of things to trade, opportunities to use. And then here's another one. These are going to be stocks that tend to trade greater than 5% up or down. So these are the ones that have potentially big price spikes, you know, so Spotify, you know, PayPal, Crocs, Datadog, a lot of different things. Now we'll update these, so there'll be a lot of new ones and different ones than what you're seeing there. All right, and then here's just kind of a open and close elite service. So here from Dan, you're very diligent and totally thorough with your analysis. That is the foundation of your success of these alerts. I paid for my subscription with the first 4 trades I took with you when I was just learning how to trade options. Please feel free to share this with anybody here today. Let's see, in February. Yeah, this is a totally different course than February. This is an earnings course. So yeah, this is an earnings course here, Michael. Yeah, so this will be, yeah, everything, you know, the strategies are kind of the basis of the strategies are the same, but they're, you know, the market environment's changed and everything like this. So yeah, they're going to be, it'll be different here. Okay, so yeah, Robert, did you get the link here? If you want to get that promo code, it's EARN, EARN 15. That'll give you the discount right there. And then Scott says it'll be the best investment you'll ever make. Go with the elite package. Great group of traders, our trader as well. So when I send out the alert again, so a lot of members do their own thing, but I'll give you a suggested option trade with the entry level profit targets based on what I call unusual option activity, or what I call my price target mapping. And then you'll get what option series to use, stop loss levels, guidelines. Trades are listed in archive for your review. You'll get a trade setup video review. Yeah, you'll get everything live workshops and everything will be emailed to you. And yeah, so and then we do, you know, with the alert package, you'll get a weekly Q&As. You'll have this for the next 4 months. They're live and recorded. Access to virtual trading room during the week, every day, 9:30 to 10:30. Those discounts. So we use a service called Telegram, and here's what it looks like here. So let me see here. Here's like last week. These go out within seconds. All right. So last week we had, going into the end of the day here, you can see a few things we were doing. Last week we had going into Thursday, we had Cisco long. We had a calendar on that. We closed that out for break even. We had a long trade on Verizon. We had a calendar diagonal. We sold that. We closed that out for a profit. And then we had also in Amazon, we had what we call a call condor. We closed that out for a profit. So these are, you know, the kind of what it looks like when the alerts go out. So I'm constantly updating and giving you, you know, alerts as to, you know, what it's doing, if we need to adjust, if we need to do anything there. So you're constantly getting updates. So let's just go through the alert service real quick. I'll go through and show you a few examples, then take questions. So again, you know, we've had since inception, we've had the alerts have been 717 closed out trades, 520 winners, break evens 44, losers 153, winning rate hovering around 79%. Sometimes we've been up to 80, 82, 83, but we, you know, tend to stay around that 79, 80%, trying to keep those winning percentages up. And here's you know, the earnings trades here from KG. Just said I made a lot more money than 1,200 on my first trade. Larry suggested in text. Great price. So that's typical. So the earnings, these are very selective when I do send these out. And these are typically, like I said, most of them will be double calendars, but we'll do some price spike ones too, because I think there'll be a lot more of those this earnings season too. So that's why I wanted to really kind of show you how to do that in the course. So here's the couple of examples on the butterfly long condor alert service that is part of the selective service that you'll get. So since starting these back in May of 2019 through Thursday, we've had 160 of these closed out, 114 winners, 10 break even, 36 losers, 77% win rate. Okay, these are very low risk trade, average, maybe loss, a stop loss $50 per spread, but potential to make 25 times. So I'll show you one that we did where you made 25 times your risk on the trade. So like a 2,500% return, they are possible. And I'll show you a couple examples here real quick, and then we'll take more questions. So here's one we recently did. This was Microsoft Broken Wing Call Condor. And so set this up on the 14th of March. I won't go through all this real, but these are very detailed. It was traded at 423.70, and then we closed it out on expiration March 22nd. It was traded at 428. So you can just see the detail that I send out in these alerts. So here, just for example, here's where it was sent: new Microsoft long, trading at 423.70, trade set up to play daily volatility squeeze breakout above prior all-time high, et cetera, et cetera. So we did this as a call condor for $30 of risk, and then send out alerts, updates, 22nd, et cetera. So I'll just show you the trade and how this looked and how it ended up. So we set the trade up here on the 14th. It was a breakout trade. We were looking for a move over this 425, which was an all-time high. And then we did get the close right here between our spreads of the trade. So it worked out really perfect. So this was the trade setup. This was what we call a long call condor. So we were long the 422.5, call short the 425. So the spread width was 2.5. Now this is a broken wing. So we had the correct spread side, the 435 short, the 400 long. So we had a wider credit spread there. All right, so the potential max cost was 47. Now, if this thing had kept going up, we would have had a 297, but that, that's deceiving really, but the major risk was 47. And so the potential profit was the spread width of 250, lesser cost 203. So this actually did make the max profit. All right, so this was a condor specifically selected for that kind of setup. All right, so here's where it was going out. So we had this, the trade was trading here. The spread had blown out to 247. Our cost was 47, so it was up $200 or a 425% return right there. And it actually expired between the two spreads. So if you just left it on, did nothing, this was max profit trade right here of $203 or 431% return. So we call it broken wing condor. Here was another one we did recently. This was Abbott, another long call condor. So again, this was one selected for a breakout vertical, looking for a breakout on this. And so did this on Abbott. These are very low risk trades, but good risk reward ratio kind of profit. So you can see this is what we call a volatility squeeze, and we had a breakout. So we set this up for a breakout to the upside, but kept our risk super low by doing this is what we call this condor. And so here you can see we're long the 116, short the 118, just a $2 wide debit spread, and then sold the 119, 121. So the total risk, spread risk was 67 bucks. Potential profit spread up 200 less for cost. So 133 or 198% return. Okay, and this one went out right there between our spreads. So right there, so it went out up, spread blue to 178 lesser cost, so up $111, 166% return there. So what is the service for $14? It shows earnings history. You will learn that at the course. Okay, so join us for the course and you'll get all the stuff that I use. Now here's a really cool trade. This is what we call our lotto ticket. Okay, so this is one that still I'm amazed every time I look at this one. This is one that we set up. This was what we call our butterfly monthly pinning trade. So this was on Tesla on the 16th. It was trading here at 200, and we did this. Ended up actually we set this up on the 8th. It was trading at 189.35, and then we were targeting 200, which is where it went to on expiration. So this actually went up. It was up almost 2,000% over that eight-day period. So here's what it looked like. It says, new Tesla long binary monthly butterfly pinning trade. Okay, trade set for potential monthly expiration at the pin of 200 next Friday. So here's what it says to do. Buy the butterfly at 197, 200, 202 at around 12 cents, $12. Okay, super low cost trade. And then here's where it went out. I was like, wow, this was on expiration day, the 16th. Wow, almost a perfect pin, Tesla long binary monthly butterfly trading at 200. Actually, it was a perfect pin. So this was up close to 2,000% return because the risk was so low, but it still made a great profit. So here was the trade, set it up right there on the 8th, targeting up here to 200 on expiration. And that's where it was right there at 200. So here was the trade, super low risk. That's why we call it kind of a lotto trade. So we had this butterfly that we set up $2.50 wide for $12. That was the max risk, $12. And then your potential profit, $2.50 wide spread less 12 bucks, $238 per spread, 1,983% return potential on that trade. And it did actually pin exactly right there. So here it goes out, trading on the 16th. It was trading right there at 200. So it was up $231, 1,925% return. Expiration, that's exactly where it was. Max profit, 238. It was just an unbelievable trade. And here's just a couple of calendars that we just calendar diagonals that you'll also potentially get. We do a lot of these. These are great trades. So we've had, since starting this back in June 2019, 274 trades closed out, 200 winners, 14 break-even, 60 losers, 78% win rate, unaudited summary there. And just a couple that we've done recently. We just, this last week we did, we had two that we did. I didn't have those up, didn't have time to put them up, but we did one on, what did we do? Verizon, we had one that was a Verizon calendar diagonal that we took a nice little profit on, and we had another one, Cisco, and then we had, actually we had Amazon, we had a Condor on that. But here's one that we did on, this was a really good one. This was on Exxon. We just set this up this, in the 5th, it was trading at 105.80. This was a great trend trade. So this had a couple adjustments on the calendar diagonal. So you can see here on the 12th, we adjusted, it was 108.65. So we took some profit and adjusted it. So at that point, it was up trading at 109. So you can see it's trending. So we did an adjustment. And then on the 14th, we did another adjustment. It was trading at 110. And then we took some profit. It was trading up to 11.92. So here, you know, I won't spend a lot of time on it, but these are the alerts that go out, very, very detailed as to how to do it. Like you saw Scott, he said he learned how to, he was trading, making money while he was learning how to trade options. So here was the trade setup. It was going out. Here was trade where my pointer is. It was trading right here at this key moving average. That's the 200-day. And then it broke out. We followed this trend all the way up using adjustments on a calendar diagonal. And then we ended up actually adjusting this to a butterfly for a huge end of the trade. So the adjustment was on the 12th. It was trading at 108.65. We took some profit on the 13th. And then we did another adjustment on the 14th, traded 110, profit on the 15th, and we ended up, the last part, trading it into a butterfly. So here was the first adjustment, and profit target was right here on the 12th, traded here. We had set up the 106, 110 at $1.79. Now it's trading out to 364, so we were up $185, 103% return. Okay, then we did another adjustment and to work the trend up. And this was then on the 14th. Now it was trading at 110. And so we adjusted this to pushing the spread up. So we now adjusted this up to the 107 short the 15 March 112. So you'll learn how to do, this, by following these alerts. Plus I've got courses and stuff that teach you this, but you can see where this goes. Then on the 15th, it was traded at 111.92 right here. So that spread went from 151. Now it was trading at 485. So now it was up $334 per spread, 342% return. So that was a really fantastic trend trade. So these are the kind of strategies for trending trades, either up or down. And then here's just one more to see. This was on TLT. We did this for a trend trade up as well. And it was trading right here, looking for this trend up. And so we did this using a long call condor and did a couple adjustments here. But long and short, here's what we ended up with on this one. So got in the 29th, it was trading at 94.34, out the 31st, and then profit on the 1st. We did the adjustment here on the 31st. Okay, adjusted the trade to widen out the spread. And so this spread then blew out to 236. We had an adjusted price of 91, so $145 on that. All right, so it depends on what the market's giving us, but it could be a butterfly I'm putting out, it could be a condor, it could be a calendar, it could be a counter diagonal, it could be a credit spread. So there are a lot of different variations that I'll send, just depending on what the market's doing. All right, so that's everything. And again, I just want to say thanks so much for everybody being here. And if you've got any questions, please feel free to ask. So make sure to use that promo code here, and you'll get this today for 167. So earn 15, EARN 15 small cap, and get that reduced price. Or if you do the alert server, you'll get the 15% off that as well, plus all the additional bonuses. And I look forward to seeing a bunch of you next week. So I hope this helps, and any other questions, let me know.